Hello, everybody.
Hello.
Hello. Hello. Gosh. Can you hear me?
Yes, David, I can. Hope you can hear me too.
Great. I can hear you. We're live. We're live. We're live.
Lovely.
I think, let me see. Good morning, good afternoon, good evening, everybody. Could you type in the chat where you're connecting from? I'll just say hello. I can hear some background music. Maybe we can switch it off. Great. Good morning, good afternoon, good evening, everyone. So I'm just typing hello. I am connecting from Lagos, Nigeria. Let me see. Tell us where you're connecting from, everybody. Paul connecting from Port Harcourt, where the oil is in Nigeria. Okay, very nice. Okay, connecting from Port Harcourt. Where else? Let me see. Fernando is in Lisbon. For those that don't know, that's Portugal. Okay. Where else? Where else? Where are we connecting from? Okay. Just looking at where people are connecting from all over. I'm seeing who is the farthest out. Who is the farthest? Who thinks they're the farthest out from Lagos? Well, technically, this is Lagos and Lisbon, right? So I don't know what's the distance between Lagos and Portugal. Should we call it a Portugal session or a Lagos session to calculate the distance?
It's definitely a
Lagos session, okay.
Lagos session. Yeah.
Yeah, there's quite a bit of echo at your end, but yeah, that's good. So let's agree it's a Lagos session. Lagos session. That's good. Let me see. All right, I'm just getting things set up. Okay, so we'll be jumping in a few minutes. I just want more people to come in, then we'll jump in. Okay. All right. So, hi, Fernando. We are, yeah, so we are ready. We're ready. I think can just say, yeah, more people stepping in. Victoria saying Victoria connecting from Lagos. Folake, hello, connecting from Nottingham. Oh, Folake, you're probably far away in UK. Somebody from West Midlands, Chibuke from the West Midlands. We have Ade Dayo from Ibadan. We have people from different places. Excellent. Very good. It'd be nice to know what your interest is in oil and gas, really. So let me ask a few questions. What is your experience with oil and gas right now? If you can share that with us. What is your experience? Let me even say with the PIA. The PIA is Nigeria's Petroleum Industry Act. Do you know much about it? Do you have some experience about it? What's your experience typically with PIA? Okay. I don't know if you can see the answers, Fernando. We have PIA, what is it? Only 15% don't know anything about PIA, which is okay. 10% is going down. Yes, some experience. Most people are oil and gas people, right? So they know what's up with the PIA. A lot of experience. We have like 10% of experts, so it's like going down now to like 5%. Okay, so some level of experience, lots of people. I think Nigerians in general will have experience with PIA because it affects them almost directly. That's how Nigeria gets most of its revenue, right? So I can understand why quite a lot of Nigerians will have experience with the PIA. Yeah, interesting. Okay, super stuff. So I'll just quickly go through overview of our sponsors for today. Our sponsors are DBrown Consulting. DBrown Consulting does a lot of training, consulting, and offshoring services. We provide data analytics services, financial modeling services to companies all over the world. Offshoring service, you want to offshore your analytics, your reporting. You can join some US companies that have already done that. And we also do deep financial models, industry models. So very complex models, but very easy for the user, not complex in the back end. So we'll probably be showing one or two oil and gas related models so you can have a look. We've been doing that for 19 years now. Clients all over the world, quite a lot of clients, participants as well. We've trained all over the world. Lots of strategic partners. CPD UK, some of our courses are accredited by the CPD UK. We have courses with partnership with Financial Modeling Institute in Canada. We have memberships with XBRL, Microsoft, all sorts. Yes. And I'm one of your speakers today, Speaker David Brown, a managing partner at DBrown Consulting, also a Microsoft MVP on Excel and AI, and expert in financial modeling, analysis and stuff. I also like to teach a lot, but right now, and I do a lot of volunteer work. I think I have probably 10 different volunteer things I do for free. Yeah, but my main gig right now is Financial Modeling Academy. We want to train 1 million financial modeling analysts out of Africa in the next 10 years. So we partnered with the Financial Modeling Institute. We're partnering with all sorts of institutions across Africa and universities. So if you're one of them, partner with us and let's see how we can transform the competence of analysts globally. And with us, we have Fernando. Fernando, you want to introduce yourself?
Hello, my name is Fernando. I've been partnering with the DBrown for the past 3 years, mainly working on oil and industry projects. So today I'll be talking to you a little bit about PIA and the grandfather terms. But I will let David introduce you to the industry, and then I'll come back to you. Just my apologies. There is a little bit of Portuguese melody playing in the background. At this time of the year, there's quite a lot of parties going on. It's something out of my control. I hope you can.
Are the Portuguese a bit like the Brazilians? They just like to party a lot,
yes.
right?
So this time of the year, there's quite a lot of festivals going on. Every little borough has their own festival, and it so happens that it's coinciding with today's. They already started it.
Can you imagine? And you're here talking about oil and gas instead of partying. Please, in the chat, tell me, what would you rather do? Talk about oil and gas or party? Let me write in my chat.
No, let's talk about oil and gas. Seriously.
I want to ask, just generally, which would they choose? Party or oil and gas? Type in the chat, guys. Let me see. Party or oil and gas? Let me know. I want to see what kind of audience we have. Oil and gas or party? Which one? Nobody will know you, so you can say your truth. It's fine. Let's see. Oil and gas. Okay, good. They want to hear oil and gas. They don't want to party. That's what they're saying now. All right. Oil and party. Okay, interesting. All right, so good. So oil and gas. Well, if you're at the end and if you're interested, there's also a training we're doing, oil and gas training. Well, it's virtual training, so anywhere in the world you're in, it's fine. I mean, we show you how to do some complex PIA calculations and stuff, and show you how to handle really complex modeling-related things as well, where we look through a real company. So that's the training coming up. If you're interested, we'll talk about it later in the day as well. One of my colleagues will probably come in and give a chat about the course. Her name is Adeomi. She will join us later. All right. And we have the Financial Modeling Academy for those that really want to go deep into modeling. We also have that. So I'm going to jump into my few slides that I want to talk to you about, and then we can then jump into more technical stuff with Fernando. So I'm sure you can see my slides. Yes? Great. Thumbs up. So looking at my slides, there seems to be one error in Excel that just keeps popping up. So I've already talked about introductions. I'll just jump all of that. And I just want to talk about just an overview, general overview of the sector. So I'm going to talk about what is financial modeling in the first place. What exactly is financial modeling? What's economic modeling? Because fiscal modeling, you could term it economic modeling, but they're kind of related. So I have a very simple definition for financial modeling. Simply, a financial model is a tool usually built on a spreadsheet to solve a business problem. So when you have a business problem, you have financial related things you need to look at, you build a financial model. So it's extremely important you understand the purpose of your model. And I think any model you build, oil and gas or whatever, should follow a process, a deep process. So if you want to be a deep modeling expert, let me give you our process in DBRAN. We call it the DAPPER process. You want to be dapper, right? So the DAPPER process, let me share that with you. So what do I mean by this process? What is this process? Let me go on. So first, you need to define your scope and objectives. So, well, right now we're talking oil and gas. What's our scope? Maybe, for example, you're doing an M&A and you want to actually buy into, I don't know, buy into an oil field. You want to be one of those that is bidding for a particular field or bidding for a particular OML or an asset from an IOC or something. What exactly is your objective? Right? You have to define your scope and objectives. You need to acquire and cleanse data. Now, it's important to gather lots of data and try and understand what's happening. If you're lucky and you're doing a due diligence, you actually get that data directly from the source or the target. That's assuming that's what you want to do. You could simply want to buy stock, right? You want to buy shares in an oil and gas company. Well, same thing. You need to acquire data. Then you need to plan and structure the flow of how it is you're going to build this model. What is that structure and flow? So first three things is really planning for your model. And then the next is you now populate with core calculations, core data. Get all that data, and then you do all your computations, you do your royalty calculations, depending on whether it's price driven, volume driven, or whatever it is, whatever fiscal terms you're using. Obviously, you need to understand PIA back to front so that you can build every aspect of that model. Then you need to evaluate and validate and stress test. After you build your model, do loads and loads and loads of stress tests. Have a way to audit the accuracy of your model as you build it, and learn how to do that very well. And then finally, once you finish all these technical things, you need to kind of put it in a presentable way for your audience. At the end of the day, your execs will make decisions. They don't make decisions on very detailed spreadsheets. They make decisions on the outputs of those spreadsheets and scenario analysis around it, which means that you need to build that out so you can answer questions when they ask, right? And when they're asking about what scenario is this or what scenario is that. So that is very, very quick, short summary of the DAPPER approach, which is our methodology in DBRAN. That's what we use when we're building models for clients. So let me escape this and show you two. All right. Okay, so just zooming out for you to see the system we use. Quite big, giving you more extra info. So that's the DAPPER approach. You define your scope and objectives, you acquire and cleanse data, you plan and structure your flow, then you populate the core, and then you evaluate all your data, you stress test, and then you do your reporting. So that's the typical approach. Now, coming back to oil and gas. The sector itself, I know Fernando is going to talk more about this, but in general, there are rules and regulations for how things are run, and different sets of entities have different sets of rules. So I'm just going to summarize some of those rules here. So you could have maybe marginal fields. What a marginal field arrangement, right? Marginal field arrangement, smaller fields, mostly Nigerian players in those marginal fields. You take out certain fields from a major block that has loads and loads of fields. And yes, economics may make sense for you. The economics of that field may not make sense for a bigger player, right? But it may make sense for a smaller player. So those are what marginal fields are, and they have their terms. Sole risk license, well, this one, they don't share any risk with NMPC. They don't share any risk with anyone. There's 100% bear all the risk and also all the rewards, right? You also have risk service contracts. This is usually called service contracts. We don't have much of them in Nigeria. Fernando, I don't know. Do we have one more? I think, or is it two? How many do we have?
I think at the moment we have two.
Only two.
But one of them is finishing, it's closing production very soon.
Okay. So we have service contracts. What are those? Those are contractors, right? They explore, they get paid. Whatever their cost is, they get paid on top of that cost. And yeah, so they're contractors really running things. Then we have the profit sharing contract, profit sharing and production sharing are kind of similar. Production sharing is the one we kind of know, which is more cost oil and profit oil. That's how they recoup their money. That's how they pay themselves in oil, in barrels. Profit share is really paying themselves in cash. So there's a combination of those PSC agreements. But then the most popular really, I think, is the JVs. The JVs typically your partners kind of pull their cash together. They split the barrels based on their equity share. They settle all their royalties, hydrocarbon tax, common income tax, and the rest. But in Nigeria, there's also something called modified carry agreements where the bigger player, or maybe if it's an IOC, carries the government, right? And pays for everything up front and then pays a small, the government also adds, they call it an uplift, which is really an interest on all those costs that they pay. So typically, this is just a summary, not going deep at all into those fiscal terms that we have in Nigeria. So I don't know which one you're familiar with. Can you type in the chat? Which one are you maybe some of you are in oil and gas companies. Which one does your company use? Which one are you more familiar with? Can you type in the chat? Let me see.
I think we should expect most attendees to be familiar with the production sharing contract, which is a worldwide kind of contract initiated in Asia, if I'm not mistaken, either Indonesia, and then of course the joint venture with national oil companies.
Yes, JVs. Let's see. PSCs, Toby is more familiar. PSCs, Magaji is marginal fields. All right. And Magaji, marginal fields, everything. You're familiar with all of them. PSCs, JVs, okay, everything. That's good. More people, type in the chat. Tell me what you're more familiar with, right? So our poll that I asked originally, I said, what is your experience with the PIA? We had 21% say PIA, what is that? They don't have any idea what that is. 68% saying yes, have some experience, and 9% say they have lots of experience. It'd be interesting talking to your 9%, the experts in the house. Okay, that's great. So I'll reset that. And again, I will just ask one other question just to check. I don't know if you've done any, or let me just have your general experience with oil and gas in general, with the oil and gas industry. Can you just answer that while I continue? What's your general experience with oil and gas? So I'm asking, do you have deeply in oil and gas, but wanting to transition to oil and gas, or no experience at all, just here for the vibes, or you're deeply into oil and gas, right? So oil and gas, upstream, really, but yeah. So let me see. Okay, quite a half and half of you deeply into and wanting to be, all right? So would you say oil and gas is declining? I mean, you have all this electric stuff and stuff, but frankly speaking, for me, I don't know what your opinion is, Fernando, but my opinion about oil and gas in Nigeria is we need to start producing a huge amount more and a lot more gas than even oil. First, we need to move our barrels per day. I think our barrels per day is probably 1.5 million or so.
That is correct. Yeah. Just a little bit above that, yeah.
Just a little bit above, but we have the capacity, or we should have the capacity to do 2.5 million barrels per day. And we should be able to consume most of that within the country and start having higher value production, right? And we're starting to do that with the refinery from Dangote and maybe others, many other industries kind of spawn out of that. But gas production, I think we can skyrocket our gas production and oil production. We just need a lot more investment and a lot more support and, I'll say, Let me just put it bluntly, seriousness. You just have to be serious, right? Yeah, so that's something we need to do. And to do that, we need a lot of planning. Good part of planning is modeling. So that's where we connect. So I think you finished the poll. Deeply into oil and gas, 36%. We have not into oil and gas, but wanting to transition. But most of us are wanting to transition, 50%, and 11% are just here for vibes. Interesting. So, okay, nice. Thanks for that. All right, so the industry itself, we know we have so many blocks in Nigeria. I have a visual here that Fernando designed, and this is based on research information, research data. So if you look at this chart, let me tell you how to read this chart. So you have revenue. I always mix it up. Is this X or Y axis? And Y is the bottom bit, right? So, and we have revenue up and down. Yes, revenue in US dollars, right? From 0 to 4 billion, right? And then you have returns, which is net profit on the other axis here from 0 to 100, right? Or your returns in percentage. And then, your returns in percentage. What's your returns? Is it percentage ownership, is it? What's the bottom bit? 0 to 100. What's that?
Yes, that's correct. So your return obviously can never be 100%. Otherwise, it'd be you'd have no cost pretty much, no deductions.
Yes.
But yeah, so what you have here is your pretty much your net profit. In this case, given by the curves, and is a distribution of all these assets. Profits, depending on the terrain depth.
So depending how productive the fields are, productive the assets are, where do you want to be? Typically, you want to be the top right as much as possible. Top right, huh? So
that's correct.
So you can say, okay, if your revenue wants to be all the way up, and your profits you want to be all the way up. So these is a billion. Let's just say $1 billion in net profit, right? This line you see here is $1 billion. Anything within that line is $1 billion. Anything within this line is 500 million in net profit. And then, so all these things in between these two lines are technically between 500 million and $1 billion, right? And then you have your revenue figures here. So if you look at Bonga, right? Bonga is like our most, would you call it the field with the most revenue? The field with the most revenue in Nigeria. The field with the most profit, apparently, is this Baran Ubi, OML 28. I only know it by the OMLs. I don't even know the names, right? OML, even Bonga is OML 118, I know. So OML 28, how special is this, right? And if you look to the right, you see the legend here. These are deep water fields, shallow fields, and onshore fields, right? So this green here, this is an onshore field. This blue, this is deep water. So definitely most of the terms of deep water PSCs, right? So your shallow water, these are your shallow water. So what's the most profitable shallow water field in Nigeria? Or should I say, what field brings the most revenue? Is this field here? We haven't labeled it, just summarizing labels. The most profitable is probably this one here, PML 338 to 44, something like that. So this kind of chart gives you quite a lot of context, a lot of information. And some are really making losses to the left here. Probably, at the beginning of your production, when you're really not making money, you're spending money. You're spending lots of money before you start making money. So all these guys are spending off the charts, so to say. And yeah, so let me look at this chart in another perspective. This is based on terms, right? This is based on asset types or fiscal terms or arrangements, as different people call it, right? So you have Bonga again. This Bonga is your PSC. You have your NNPC JV, you have MCAs, which are typically NNPC JVs. It's just that they have a modified carry agreement. Modified carry basically means that the entity, let's assume it's a Shell, it's a Chevron, it's a Seplat, whatever, those entities are carrying the government, right? And paying all the bills. The government, the PSC, they're partners, they have shares, right? They have equity. But sometimes cash calls come and the government doesn't pay, right? So at the end of the day, the partner pays, and there's a small agreement with them, though you can pay for my 1 billion that I owe, and you can have a small uplift, which is interest, which I'll pay you back, and I'll pay you back in oil, right? Most times it's paid in oil. So that's what the modified carry is. So you can say NNPC JV, there's some that are MCAs, right? Are they all MCAs, by the way, Fernando? NNPC JVs, or just a few? Or is it most of them have MCA? Which is it?
No, just a few.
Yes.
I mean, most of them have a carry agreement. The modified carry agreement is when the IOCs in this case could not get the cash calls on time, so they decided for the modified carry agreement. Essentially, what it is.
Interest.
It's instead of waiting for the government to be able to pay back, which usually take typically a year or more, they deduct all the expenses, all the capex expenses. So that's one way of recovery. That's one of the mechanisms of recovery they found.
Yes, and also there's also an interest portion there, which kind of makes it that modified carry as well. I think they call it an uplift. But anyway, it's not as easy as we say. It's a bit complex, and different agreements and different special terms are in there. Sole risk, we've already talked about it. You have your marginal field. Sole risk are the blue ones here. You can see some of the sole risk, pretty profitable sole risk contracts. But of course, Bonga seems to always be at the top. Then what about gas, right? So everybody keeps saying that we are a gas producer, not really an oil producer. We have more gas than oil. We have some really massive reserves of gas, but we haven't developed them, or we're developing them. And that is one of the items that PIA was trying to solve, right? And I'm sure when Fernando starts talking to us about this, you will see more in depth about how that was, what provisions are going to help us produce more gas in Nigeria. So if I look at it as from oil and gas perspective, if you want to read this chart, you can see wherever the pie is, the pie starts right from 12 o'clock. From 12 o'clock going right, circular, as in clockwise. Clockwise is where the gas is, right? So here you have this Bara Ubi. They are mostly a gas field. Is that so, Fernando, or ML28?
That is correct. I mean, just to summarize, most of the production, or most of the revenue comes from the oil production. In some cases, you have some gas fields which are, produce gas rather than flaring. I mean, in oil industry, gas is produced with almost in oil fields. Unfortunately, there's a lot of gas flaring. Despite the regulations that find the gas flaring and so on, there is still a lot of gas flaring. And what the PIA did was to provide incentives for the gas utilization, and therefore making Nigeria one of the biggest producers because indeed the gas reserves are fundamentally one of the biggest assets in the oil hydrocarbon industry that Nigeria has. So, but up to now, most of the revenues do come from
oil. Yeah, they still come from oil. Yeah, but I'm sure, hopefully, I don't know, some of the experts in the house, the 11% experts in the house, when do you think Nigeria will start getting most of its revenue from oil? I mean, from gas. Just type in a year. You know, you guys are experts. Just type a guesstimate of which year will gas revenues now exceed oil revenue. I'd love to know your perspective. Experts
Let's look at the news from the chart. So it seems that gas producers are quite profitable here, right? So
you see,
every incentive plus all the work the government is doing in the background to all the projects they undertaking to make sure the African pipe, the gas line, African. Now the name is a little bit. Losing, but there is the intention is to be one of the biggest producers and therefore suppliers for the gas African pipe, right, that crosses through the Sahara Desert all the way to the north.
Anyway, we can see, I mean, at the end of the day, there is potential, but I don't like that word much in Nigeria. I've heard it too many times, potential, right? But anyway, anything going towards the right, you know that they're super profitable, and you can see gas fields, majority gas. This is half and half. It's majority gas, some gas, and this is all gas. So there's quite a bit of profitability coming from gas, I think, which is important to note. And let me see which predictions we have. Anyone brave enough to do predictions of when is gas going to exceed oil in revenue? Let me look at the chart. Yes, deeply in oil and gas. Okay, so type in the chat when you think, what year will gas exceed oil? Another chart, this is government take, right? So of these, see these pies? You see the red, that's government's take from this field. So if you look at Bonga, for example, I mean, you can see the majority of Bonga's government takes majority of that. And of course, if you look, that's for PSCs, right? And then you have, where does government take the least? Okay, look at this NNPC JV here, and this is a gas field as we've seen. Yes, we look to the back, you see this is mostly gas, and government take is not as much, right? So this is super profitable for the owners of this. I would love to do more research on OML28. It's really great. So you have sole risk. Sole risk, again, you can see government take. I'm surprised at this one, actually. Is this Agbami? I can't remember how this one is. The amount of government take is quite large, I would think, for a sole risk. That means they pay. Obviously, what does this mean? Royalties and all of those stuff paid up front, they're not producing as much, probably. But it'd be nice to analyze that. So you can see all the reds the government take out of these assets. So the oil and gas industry is quite interesting in Nigeria. Which terms should you use? PSCs, JV, MCA, I mean, sole risk, MF. What are the fiscal terms? Now, the fiscal terms most likely are even determined by the amount of production you're doing, the amount of government involvement. But at the end of the day, PIA is here, and people are converting to the new terms. I think it's like forced conversion for some, because at the end of the day, you must convert. There's some provisions in the PIA that says, look, if you've already taken government to court on certain things, if you convert, then your court case is kind of canceled, right? Gone. So some people may have to look at that as well. But at the end of the day, how is the PIA? Is it positive, negative, neutral? Would it help bring in more investments, which is really what we need? And then what are those technical things around the terms? So I think I'll pause on these visuals. The visuals are great, but I would want to go through maybe a bit of modeling before Fernando jumps in. So as modelers ourselves, we, of course, use this approach that I talked about. We build models in detail using this framework. And then let me give you some examples of what a typical oil and gas detailed model would have. So you should have like a simulator, right? Something that simulates within your model. And this is a good example of how you simulate. So at the end of the day, if you remember our framework, you build your model, right? You do your detailed model, stress testing and stuff, but your executive wants to see reports and analysis. So you can't just do numbers, you need to do reporting. You need to make simulation analysis easy. So this is a gigantic model for the entire country, which one of the things we build in industrial models, so models with all the data for every single oil block in the country, right? And then we simulate. So here, for example, how do I simulate? I may decide, okay, I'm doing a simulation from 2025 to 2035. What is the total price of oil currently with the Iran and US crisis? I wonder what the price is today. So, I mean, you could say, look, the price is most likely going to be 20% more than this, right? So I just decide, you know what, I'm going to put a price of $90 per barrel, right? And then I'll just simulate $90 per barrel all through. Like I could change the price to anything if I like. The various years, I can increase it by a percent. And then I can decide, you know what, any PSC in the country, most likely the production is going to increase to so barrels, maybe let's say 2019, instead of 392,000 barrels from PSC, it's going to be 400,000 barrels per day. It seems NNPC JVs want them to go to 1,000 or 1 million barrels per day, and they want to maintain that over time. And then sole risk is whatever. And all of those things, obviously, if you're simulating as a modeler, you're saying in 2029 this is going to happen. That means you should have invested, right? That means there should be some form of investment at some point. So you now go down to more OPEX and CAPEX and say, you know what, I think for us to reach those 2029 numbers, we need to increase investments, right? So increase investment, let's say this year to this year, we're going to increase investments by 10%. So whatever investments were at the time, we're going to increase them by 10%. Whatever investments on NNPC JVs and stuff. So this is like a simulator. Once you've run the simulator and stuff, the entire model updates, and then you get your answers and do your reporting tool. Let me give you ideas around what you should calculate when you're running an oil model. So just like our framework, you need to get data. Yeah, so you need to get data, asset data, pricing data, production data, cost data, all this data you need to get. And because we're not certain about the future, you need to have simulations of that data. I've just shown you the simulator tool, but at least get that data, right? So that's key. Let me zoom out a little bit more. So then, of course, you need revenue computation. So you probably do your oil revenue in real terms and your gas revenue in real terms. So what dollars are we using? Are we using today's dollars? Are we using tomorrow's dollars? You need to understand inflation and know exactly how, what are we projecting as? Are we doing in real or nominal? And you flow that through the model. Other income computations, what other income computations do you have? Are you using condensate NGL revenue streams? Do you have those revenue streams? Then timing is also critical. When is investment coming in? When is it going out? When is equity coming in and out? Because that will determine your return on investment. That will determine your return on invested capital. So timing is super important in any model. So you have your detailed timing flag. Then, of course, you have all your rates, right? This section contains a compilation of all the rates used in the model. Every single rate you can think of. You have that detail there. And then, of course, you then have your government charges, your bonuses, abandonment charges, indirect taxes, levies, and fund payments. You have your royalties and all the ways calculation of royalties based on PIA. And the thing about this is, since we're moving to PIA and you're doing a evaluation or you're doing a model, you need to actually build the model in two ways, both the grandfathered act, which is the old rules, and the new rules, because you're in a transition phase. And that sometimes is difficult for people to understand how to build into a single model. So you need to build it in a way that you have a date when it is you're transiting, and from that date, PIA. The date before, old terms. And how does that mix in? How does capital allowance move from there to the new one? You need to think through all of that in building your model, right? Petroleum profit tax, that's the old PPT. You now have hydrocarbon tax, so you can put all your calculations for all the old terms and the new terms, and then know when you switch. And the switching is going to be based on timing, right? I showed you a timing section. So you have your timing section, and those switches are going to be based on that timing section, right? So yeah, so you then have education tax, state carry. These are all calculations, right? By the way, I don't know if you're looking at the rows, everybody. We're already on row 1,600. A lot of calculations, yes? So, yeah, but I'm definitely not going into the calculations. If you're interested in some of this, you can come for the training. But yeah, but this is a real industrial model. The asset cash flows, valuation, right? Asset cash flows, what are those cash flows at the end of the day? What is our asset valuation? This, for example, is an economic model, which means we're not really building P&L, balance sheet, and cash flow like that. We're mostly interested in cash flows, right? What are the cash flows coming in, coming out, and stuff? At the end of the day, we have cash flows that we can use for evaluation. What's the government take? Are these terms good for the government? Are they good for the entities? When do you do a ring fencing? What's ring fencing? I mean, people use that term differently. We're saying, okay, for JVs, if you have, let's say, 5 assets, in your JVs, different assets, and one asset is making a loss, another asset is making a profit, you can bring that loss and profit together and pay tax. So let me give you a simple example. If one asset made a 20 Naira profit, another asset made a 10 Naira loss. If you pay the 20 Naira profit, and let's say tax is 10%, 20 Naira times 10% is what? 10, 22, 2 Naira, right? So you pay 2 Naira. For the loss, you made a loss of 10. Well, you made a loss of 10, nothing. I mean, at the end of the day, you probably pay minimum tax, but no tax for you. But if you're allowed to bring these assets together, then you have your asset that made a profit of 20 and an asset that made a loss of 10. You now have a net profit of 10. And the only tax you pay is 1 Naira, not 2 Naira. So when you're able to bring assets together and kind of put them together in like a fence, right? You have a fence that assets are not allowed to come in, like PSCs. You kind of pay based on each individual PSC contract. You pay their taxes, whether they make a loss or a profit. But JVs, you can bring them together. So again, all these things you need to factor into your decision on how you want to, what kind of term makes more sense for you, right? In what kind of fiscal term is more profitable for you. Obviously, the government also wants to know what kind of term is more profitable for the government, right? So these are the things around negotiations that you'll do. So this is just a summary of a full-fledged detailed fiscal model, right? And what the line items are. There are lots of inputs involved, quite a lot of calculations involved, but you need to follow a detailed process so you reduce errors and you're able to put outputs that make sense. Now, calculations are useless without outputs, so it's also good to have outputs. So look at this, for example. These are the detailed outputs for every single block. You want to do evaluation and stuff. I don't know, OML. What OML was I interested in? What's that? OML. Let's see, that gas OML. Let me go there. OML 28. Okay, OML 28. Let me see if I can find OML 28 here. Hi, Fernando. Okay. OML 28. Let's click on OML 28. And so this whole reporting tool updates, builds all the data. There are millions of calculations going on in the backend, guys, on this. And then we can do a simple valuation. We can see, okay, what are the inputs and stuff, outputs coming out of this OML, really started making money or spending money, I should say. This is OPEX. If I can check, let me see I want to check revenue on gas. So revenue on gas really started around 2010. That's when they were really making some serious revenue on gas, right? Most of the other time, I think it probably was oil, if they were still producing at that time. So yeah, I can do all sorts of analysis, right? Very detailed analysis and valuation and all sorts with this reporting tool. So when you build a model, the model is not a static thing. It needs to be used for strategic decision making, and you need to be able to use it as a tool. Use it as a tool on a daily, weekly, monthly basis to make decisions, right? A lot of times I see models, they're meant for a purpose, one simple purpose, and they don't take advantage of the massive tool they've built to help make strategic decisions throughout the life of the asset. But I'll pause here because we want to go into the fiscal terms in more detail. So, Fernando, I'm going to hand over to you.
Sure, great. So when it comes to the oil industry, I guess you have two main players. You have the investors and you have the government. And yes, you might have a lot of resources, but the investment landscape is one of the important factors as to why you would be able to tap into those resources. So oil provide one of the greatest incomes for the government in most oil-producing countries. Nigeria is no exception. It contributes one of the sectors that contributes the most to the GDP as well as to the government revenue itself. And therefore, as we know, there is a transition going on in the world where a lot of countries are willing to go green, that including gas, moving away from oil. So this poses quite a big threat to all these developing companies developing countries that rely a lot on oil production. With this in mind, with the idea of guaranteeing the energy security for Nigeria, there has been a long-awaited simplification in terms of the fiscal landscape in Nigeria. So that happened with the PIA being passed in 2021 and becoming effective in 2023 mostly. But the big question is whether the fiscal terms, the new terms, have made Nigeria a more attractive country in terms of investment. So a lot of reports out there do say that with these new changes, Nigeria now moves further up into the park, further into the top quartile of becoming one of the most attractive countries for oil production. As you can see, despite the fact that oil is quite profitable, from the previous charts you could see from David, there is still Nigeria is still not producing the capacity. So the interest of the government is to make sure that is the case as soon as possible, including, of course, the gas section as well of the investment. So let me just share a screen with you very quickly. Okay, so as I was just summarizing, PIA came into effect in February 2023. Those were one of the, with the compulsory conversion of most marginal fields into the PIA. But even though it was compulsory for some assets, which mostly the marginal field, only about 10% of the assets have converted. So essentially the Nigerian oil and gas sector runs into this fiscal terms, which is the grandfather, everything, all the legislation that happened before the PIA and now the PIA. Between the two, they're not so different. They both have the turnover taxes, the bonuses, royalty, levies, and funds, and they also have the income taxes. So the income taxes have changed slightly. Now the petroleum profit tax, let me make this bigger. The petroleum profit tax has given way to hydrocarbon tax. Company tax remain, but it now taxes all incomes. And of course, you also have the usual tax credit allowances to foster investment. And as David pointed out earlier, within each of these distinct group of legislation, there is still the production arrangements defining exactly what those benefits are. I mean, what the tax rates are, what investment tax rates are, and also the terrain. So it is known that the investment will always vary per terrain. Deep water investments are a lot more expensive than shallow and onshore. And therefore, if you want to promote deep water investments, such as you've seen, one of the biggest producers is Bonga, and therefore it involves a lot of risk operating in deep water. If you want to foster that kind of investment, if you want to increase your reserves, which a lot could be found in deep water, you need to make sure that investment in deep water is less risky, and we can do that with legislation. Also, the type of contracts that might be beneficial or not for the government. So David talked about PSCs and NPC JVs, so listed marginal fields. So essentially, some of these, the NNPC JVs are the ones where the contracts on which the Nigerian government participates directly into the investment, and therefore it's a joint venture. You have the PSCs, which tend to be very attractive to government because there is no need for government to invest any money. In fact, they just take a share of the profit once oil is produced. And then you have solids, which are pretty much independent operators. So as from these two legislations, what's important to take in consideration here is very much the turn for each of the production, for each of the asset types, and as well as the terrain they operate. Those are the specific turn for each of the assets. And unfortunately, fortunately, of course, as well, these assets will belong to a company, and the company can own assets in on each of these production arrangements, as well as different terrains. So ideally, if you're creating your model for a specific company, you want to know the assets you own and the terrains you operate on. And of course, if you also have some assets that have converted to PIA or not. So if you want to make a model that covers all of this, it's important to know your legislation very well. Fortunately, there's a lot of good summaries out there. I would say that that's not enough. That was our experience. It did take us quite a lot of time and a lot of collaboration with the main agencies in the country for us to learn about these little details for, tax rates for different production arrangements, as well as, the terrain was a lot more easy to find. But as you know, the previous legislation did kind of impose the levels of secrecy in the industry, especially with PSCs. It's very difficult to come around a production sharing contract, so you know that the terms by which the companies operate under. However, of course, if you're working with a company, you would know these terms first time because you'd be from your company. Our challenge was in the sense that making a model for the industry was that we would have to find out by ourselves what these terms are. Again, my recommendation is always stay abreast of the current legislation. There is always new legislation being passed, knowing this will allow you to have the most accurate predictions in the market when it comes to valuation and of course profitability as well in your company. So as I pointed out earlier, the structure of both legislations are very similar. Starting with your turnover taxes, these are pretty much the government collections that depend pretty much on how much you make, how much you produce, not so much about your profitability. When it comes to turnover taxes, they pretty much all similar, except for royalty that has changed a little bit. So with the PIA, the intention was to focus more on production and promote or support assets that produce a lot more, rather than focusing on the different terrains. Even though that's still the case, of course, because hello.
No problem. I just couldn't hear you, so I reconnected. Thank you.
Okay. So yes, the royalty has changed a little bit, and then when it comes to income taxes, the petroleum profit tax gave way to hydrocarbon tax. The main difference is that hydrocarbon tax, when compared to petroleum profit tax, taxes all non-associated gas liquids, whereas the petroleum profit tax did tax all liquids, which also includes some non-associated gas liquids. And then when it comes to the income tax that in the grandfather terms used to tax only gas revenue, now in the PIA tax all incomes, that is oil and gas incomes as well as incidental incomes. And then of course you have the tax credits to rebate, tax credits and allowance to rebate on the income taxes. On the PIA, they more focused on production, whereas on the grandfather, they're more focused on investments. So the more you produce, the more, currently the more you produce, the more your tax rate and allowances, the higher they should be if you convert to PIA. So with respect to this, PIA is supposed to be, of course, more attractive because the rates are supposed to be lower. So the effective income taxes are about 60%. Sorry, yeah, it's at 60%, whereas in the grandfather used to be up to 85%. So with this in mind, the PIA is supposed to be a lot more attractive, but of course it's only attractive if you also produce, if you are a big producer. There is a lot of reasons why a lot of companies have not converted. There is a gradual conversion going on. When, of course, the licenses expire, which will be a lot of them will be expired in the next 10 years, they will have to compulsory convert to PIA. But so far, we only have about 10% of assets in the new terms, which means that when, of course, you're modeling, you need to take into consideration both fiscal terms and, of course, also plan for the transition, which might not be. So if you are a company which holds many assets, they're not all going to be converted at the same time. And therefore, that can pose a little bit of a challenge to model all of these company outputs as well as the government take outputs. Okay, so I think at this point we could come back and take some questions. David, what do you think? Hi, David. I think David is facing some technical challenges. So I will ask you to submit your questions if you have, so that we could answer some of them. So, Lexi, I can see a question from your side, but I'm not quite sure what the question is.
So if you would also like to come into the studio and ask your question, you can do that as well. You can put your speak to hand up and we'll bring you in. But really would want you to ask questions in the question Q&A box. There's a Q&A button. If you can ask it there, that would be great. Q&A button. Yeah.
Okay, so we have our first question from Oliver. Oliver is asking, what's the difference between the grandfather and the PIA? So the grandfather is a collection of legislation that has been passed from the inception of the oil industry in Nigeria up to the PIA. So every legislation up to the PIA, before the PIA, it's termed grandfather. I mean, there's also other terms for it, which is legacy legislation and so on. So PIA, of course, is a new legislation which was passed in 2021 that's supposed to substitute the old legislation. However, it was not compulsory, which meant that companies would or able to choose whether they would convert or not to the new terms. So that's pretty much the difference between the two. Any further questions? Okay. Okay, instead of questions related to the legislation, is there anything else you'd like us to look at while we still have time? A few more minutes. Okay, so we have a couple more questions coming in. So we have one from Paul. Paul is asking, how are the new investors in gas business giving exemptions under the new PIA, tax holidays and so on? So when it comes to tax holidays, unfortunately, there's legislation that covers the tax holidays has exempted the oil industry from these from tax holidays itself. That happened back in 2018, if I'm not mistaken. But however, there are quite a lot of incentives going on. So lately, in 2024, the government has passed the Greenfield non-associated gas incentives, which is meant to provide a lot of tax credits for new gas investments. So I believe the legislation landscape is trying to go for the kind of tax benefit that comes with intention to produce. So that's what the production tax credit are based on. So it's not so much about tax holidays anymore, Although there is the CIT itself does provide for some incentives when it comes to minimum tax payments. You still have only the 4 years for any losses you make. After that, you have to pay minimum tax. But I would say that most of the incentives are being provided through production tax credit. The more you produce, if you show intention to produce, you are rewarded with quite generous tax credits and tax allowances as well. Any more questions? Paul, I hope I answered the questions. If you have any more questions, you can always email us. Hi, David. Is there anything else that you'd like to cover? Thank you, Paul. I hope that was helpful. Anyways, when it comes to the PI, it's such a huge subject. I mean, the entire legislation of oil industry in Nigeria, and it's such a huge subject that I personally myself, but I believe the entire team at D Brown always look forward to engaging in discussion, because there's always something new you find. So I believe in the future we'll be organizing sessions on to discuss the legislation, where we should go into much more detail. There, I believe we can explore what the current consensus is, because if you start modeling, what you'll find is that despite so much resources out there when it comes to legislation, there is quite a lot of questions yet to be answered. There's quite and of course, we rely on many of these organizations, NUPRC, the FIRS as well, to give some clarifications and guidance. But there is always quite a lot of questions yet still to be answered in order for you to be 100% sure of how to handle all of these rules that come in, and even the existing rules as well. So probably we should set up one of those very soon, and all of you would be invited to partake as well. I believe we should be able to share a couple of slides. Yes, I will find out with David what will be shared. Ade, I see a question from your comment, probably. Perhaps I want to believe the sample report Mr. Brown presented as our end report, especially as it contained economic model, not just financial model. I'm not sure what the request is. So what David has demoed earlier, it's the Nigeria oil and gas financial model. In fact, is a pack of 4 tools that allow you to extract data, simulate outputs, and then analyze those outputs. So I'm not sure that's available for distribution. But if you have any questions about that, do contact us in D Brown, and we can talk to you about it. Okay, Falaki, I will check that now. Okay, well, apologies. All right, so I'll go from the top to bottom. So, question for
Hello.
Oliver. I think that's already been asked. What's the difference between grandfather and PIA? Question from Shibuki Emmanuel. Is JV concessionary? Yes, it is. As a simple answer, yes. So there's two types of contracts. There's concession and PSCs. PSCs differ quite entirely from concession in the sense that PSCs don't own what they find under the ground, but concessions do. JVs are concessions where the government partakes into the investment with other companies. So that's pretty much what the JV is. It's an NNPC JV, which is a concession.
Okay, hi Fernando. Can you hear me?
Sure, yes, I can.
All right. Hi. Thank you so much, Fernando. And thank you everyone for joining the webinar and your questions. So just before we take a few more questions and we wrap up the webinar, the offer for the Oil and Gas Corporate Financial Modeling Training is coming up very soon. So from the 22nd of July to the 2nd of August, the training is going to be delivered virtual. There'll be 10 instructor-led virtual sessions, right? And we're offering a 30% off this training at the moment. So the offer is currently up. You can just click on that and it'll take you to where you'd pay so you can secure your spots in the training. Okay, so Fernando, I don't know if you'd like to take one last question before we wrap up the webinar.
Sure. I think there's one more question I could take. That is from Folaki. It's asking what's the difference between the project economic modeling to estimate the profitability of a project and modeling to determine the valuation of a company based on its assets. So I guess when it comes to terminologies, when it comes to modeling, there's indeed a financial modeling as well as a project financing model. So the project financing is a little bit more robust when it comes to taking into consideration the different stage of investments, and therefore, when it comes to industrial projects, I would say project financing is models are a little bit more robust than financial models. So that would be my my preference. I would work with the project financing model rather than financial models itself. So financial models are more for, let's say, banking industry and so on. The project financing goes into a lot of the technical details that make a lot of difference into asserting what the revenues will be, what the cost will be, and so on and so on. So I hope that helps, Folake. And then there's one more question from Oliver Akamabi. For someone transitioning into oil and gas and I would say this means want to understand the field in terms of terminologies, laws, etc., what resource could be recommended for an undergraduate? Okay, so I guess one of the things, there is a lot of material out there. Again, I can attest to that because I was initiated into oil and gas very recently. So even though I work in this industry for a long time, oil and gas is also a very recent industry for myself. And I had to research quite a lot. I had to find a lot of information for myself, even though there was quite a lot of information already gathered when the project started. I had to supplement by going online. I can assure you that you can find a lot of information out there. I would recommend that you start with the tax summaries that the typical Big Fours do provide in every country. Also, if you just use artificial intelligence nowadays to do a search online of what the terminologies are, you will get a pretty decent summary, which cover not just Nigeria, but the entire global oil industry. A lot of these contracts, they essentially the same from country to country. What differs are the tax rates and some special conditions in the country. So the resources are the tax bills themselves. I had to read tens, thousands of pages, and maybe a number of times. So I would say start there, start with tax summaries, and complement with the research online. Oliver.
All right. Thank you so much, Fernando. Thank you again, everyone, for joining this session. I'm very sure that you got a lot of value from the session. And as I said, for the training that's coming up, we'd also have experts like this taking you for the 10 weeks of training, so you can see what you'd learn from the training that is coming up. Thank you, everyone, for joining, and we hope to see you on our next value-based webinar. As always, thank you so much for joining. Please don't forget to register for the course if you're interested in taking it. We have limited seats, so it'd be very nice to have all of you in class. Thank you again, everyone, for joining. Thank you, Fernando, for the session. It was really
Thank you, everybody, for the
insightful.
questions. Thank you.
Thank you, everyone, and we'll see you next time.